He sat at the kitchen table in Box Hill, Melbourne, the laptop open, the Australian super login screen still glowing, and he typed in his balance, $412,000. He looked at the number, then he looked at the Centrelink letter sitting beside the laptop, and the question that had been sitting quietly in the back of his mind for months finally surfaced. Does this super balance mean I get less pension? The short answer is yes. Your super does affect your age pension. But the way it affects it, the mechanics, the tests, the thresholds, that is what nobody explains clearly. And that is exactly what we're going to do right now, step by step. Real numbers, no jargon. So let me start with the single most important thing you need to understand. Centrelink runs your situation through two separate tests. Two, not one. The first is called the assets test. The second is called the income test. They calculate your pension under both tests, and then they pay you whichever amount is lower. That is the rule. Whichever test gives the lower result, that is what you get. And your superannuation, whether it is sitting in accumulation or whether you have started drawing an income stream, is assessed under both of those tests once you turn 67. Both. That is the part people miss. Now, here is something important, and it catches a lot of people off guard. If you're under 67 and your super is still in the accumulation phase, Centrelink does not count it. It is invisible to them. They cannot see it. But the moment you reach age pension age, 67, everything changes. Your super becomes a countable asset, all of it, whether you are drawing from it or not. Picture a woman in her early 60s sitting in the car park outside the Services Australia office in Joondalup, Perth. She has been told she is too young for the age pension. She has $300,000 in super. Right now, Centrelink does not assess a single dollar of it. But she knows, and this is the part that keeps her awake, that in a few years, when she turns 67, that same $300,000 will suddenly appear on their radar, and it will change what she receives. So let us talk about how that works in practice, starting with the assets test. The assets test is simpler than people think. Centrelink adds up everything you own, your savings, your shares, your car, your furniture, your investment property, your super balance, everything except your family home. If you own your home, the house itself is exempt. It is not counted. Under current rules, and these thresholds are indexed, so they do change, if you are single and you own your home, you can have up to about $333,000 in other assets and still receive the full age pension. For a couple who own their home, it is about $499,000 combined. Below that line, full pension. Above that line, the pension starts to taper. It does not disappear. It tapers. And the taper rate is $3 per fortnight for every $1,000 you are over the threshold. So if you are a single homeowner with $350,000 in countable assets, that is $17,000 over the line, your pension reduces by about $51 a fortnight. Not the end of the world, but it adds up over a year. And this is where people feel the anxiety. Every dollar in super, every dollar in the bank, every dollar in that term deposit, it all counts. And I have sat across the table from people who genuinely worried about depositing a $2,000 tax refund because they were afraid it would push them over a threshold. The truth is, a small deposit like that shifts your pension by about $6 a fortnight. It is not going to change your life, but the fear is real. And it exists because the system does not explain itself clearly. Now, the full pension cuts off entirely for a single homeowner at about $733,500 in assets. For a homeowner couple, it is about $1,102,500 combined. Above that, no age pension at all. Zero. Let us stay with that for a moment. Because what that means in plain language is this. If your super balance plus your other assets sits between $333,000 and $733,500, you're in the zone where every dollar directly affects how much pension you receive. That is the zone where the details matter. Right. Now let us move to the income test, because this is where it gets genuinely fiddly. But stay with me. Centrelink does not look at what your super actually earns. They do not care if your super fund returned 8% or 2% or lost money. They ignore the actual return entirely. Instead, they deem that your financial assets are earning a set rate. That rate is currently 1.25% on the first $66,800 of financial assets for a single person and 3.25% on everything above that. Let me show you what that means with real numbers. Say you are a single person with $400,000 in super and another $20,000 in a savings account. That is $420,000 in financial assets. Centrelink deems the first $66,800 at 1.25%. That gives you about $835 a year of deemed income. The remaining $353,200 is deemed at 3.25%, roughly $11,479 a year. Add those together and your total deemed income is about $12,314 a year, or about $474 a fortnight. Now, as a single person, you can earn up to $226 a fortnight before your pension starts to reduce. So that $474 minus $226 leaves $248 of assessable income. The pension reduces by 50 cents for every dollar over the free area. So your pension drops by about $124 a fortnight under the income test. And here is the part that frustrates people. Your savings account might be paying almost nothing. 0.5%, maybe less. But Centrelink calculates as if it is paying 3.25% on most of it. The gap between what your money actually earns and what Centrelink assumes it earns, that is where the resentment lives. And it is completely fair to feel that way. The deeming rate has not kept pace with reality for years. He was sitting on the back veranda in Redcliffe, north of Brisbane, looking out at the bay. His super sat at $412,000. He owned his home. He had about $15,000 in the bank. Under the assets test, his countable assets, $427,000, put him about $94,000 over the full pension threshold. That reduces his pension by about $282 per fortnight under the assets test. Under the income test, with the deeming calculation we just worked through, his reduction would be about $124 per fortnight. Which one does Centrelink use? The one that gives the lower pension. In his case, that is the assets test, the bigger reduction. So his age pension would be roughly $919 per fortnight instead of the full rate of about $1,201. Still a meaningful payment, still a significant part of his retirement income, but lower than the full rate because of his super. And this is the conversation most Australians never have until they are sitting in that Centrelink office with a folder of documents and a ticket number. The relationship between your super and your pension is not simple. It is not a single rule. It is two tests running side by side, each with its own thresholds, its own rates, its own logic, and whichever one produces the lower result is the one that applies. But here is what I want you to take away from this. Understanding how it works does not just reduce the anxiety, it gives you options. It gives you the ability to ask better questions when you sit down with a financial advisor. It gives you the ability to look at your own numbers and say, right, I understand where I sit. I understand why the pension is this amount and not that amount. And that understanding, that quiet confidence of knowing how the system actually works, that is something nobody can take away from you. Now, these figures I have used today, the thresholds, the deeming rates, the taper rates, they are all current under the rules as of this financial year, but they are indexed. They change. So before you make any decisions, always check the latest numbers on the Services Australia website or speak with a qualified financial advisor. If this helped, if you feel like you understand something today that you did not understand yesterday, then this video did its job. And if you want to go deeper, I have another video that walks through the deeming rates in much more detail and another one that covers the assets test thresholds for every situation: homeowner, non-homeowner, single, couple. I will leave those linked for you because the system is complicated, but you are not the problem. The system is the problem, and explaining it clearly, that is my job.